I'm really glad to moderate this session, which is the last session of the evening, and considering the content, which is really remarkable, which has been developed since last 2 days, I think I'm so sure that we are going to get some great insights from these sessions as well. Whenever I look at co-lending, I always feel and think that actually how is co-lending working, how the collaboration model is working, because जो कहते हैं कि दो भाई एक साथ नहीं रहते, माँ बहू तो छोड़ दो, but and most of the businesses are fighting with the wealth which their parents have generated today. How the two business companies will work together, and that too in a lending business where everybody wants to have a decent margins, is always a question. But again, regulator has pushed this particular product, and I think both the companies are working in this direction seamlessly. So let me take opening remarks from all of you on a very basic and a specific question in terms of how's the co-lending model shaping up, because the co-lending between banks and the finance companies, whether 80-20, or also in a way the partnership model which the fintech NBFCs also have, kind of collaboration is increasing on these backgrounds. How's the co-lending model shaping up in India? And I will start with you, Shachindra.
So it's an interesting question. I think so co-lending came out of a necessity. So as you will recall that September 2018, and then after that when ILFS happened, then DHFL happened, banks, the NBFC model survived because banks give them the money and they are supposed to give money to others. What has happened that bank gave money for some purpose, but the money went somewhere else. And finally, it was realized within the banking system, regulator and the government, that NBFCs are required because they do, serve a market which otherwise banks are not being able to serve. But banks should not be taking the risk of lending to the balance sheet of NBFC. So it is out of the necessity of banks, power of liability or the capital being utilized through intermediation of NBFC, and ultimately the end customer is being funded, right? And from there, because end of the day, if a bank lends through an NBFC to an end customer, something happens to the NBFC, banks know that its money is with a borrower from which bank can recover. I think so we are at the stage one. I keep saying this, the securitization in India started in 1992. The first securitization transaction was done in 1992 when Shriram Transport Finance sold a portfolio to Citibank. And it has taken almost 3 decades for securitization to mature. So compare that to the co-lending. In 2 years, co-lending has come of age, wherein banks' acceptance of the model, how they want to do it, and sheer focus. First it started from, push from the government, then from the regulator. But now actually banks are finding it as an attractive business line to generate profitability. And, I said this around 6 months back, that rolling forward in next 12 months, 50,000 crore worth of co-lending in India would happen within the mortgage and MSME financing business.
That's a huge number. Vikrant?
Yeah, pardon my... I have a bad throat, so I'll be try to be as clear as I can. See, as I see it, why is the need for a bank to come to in this model? If you really look at it, there is a massive PSL requirement. The total PSL which gets originated, say in the last year, was to the tune of about 47 lakh crores. And there was obviously a shortfall which banks could not fulfill, mostly in the in the micro business segment, and this was for the public sector banks. And for the private sector banks, it was more on the agri and small business side. And if they are unable to fulfill this requirement, what are they supposed to do? They are essentially do two things. Either they get and go and buy PSL certificates, which is essentially trading of somebody who's a higher generator of PSL and somebody who's deficit. So there's a trading of PSL certificates which happen. And secondly, regulatorily, in order to meet this critical requirement, you have to otherwise invest in RIDB bonds, which is rural infrastructure development bonds. So if you then again look at the quantum of what this, of how much trading happened in the PSL certificate, it was last year to the order and magnitude of nearly 6.5 lakh crore. So that gives you an indication of how short the banks were in terms of these assets. And if you look at the stock of RIDB bonds, I think outstanding today would be nearly 2.5 lakh crores. So these are large numbers. So banks, and in case you invest in RIDB bonds, the return which you generate is 200 basis points below the repo rate. So if you put all of this together, you realize that this turns out to be a cost center rather than a sort of a lending center, which is profitable from a bank standpoint. And willy-nilly, they are finding avenues where they can get into co-lending segment also to fulfill these needs. And who comes and fulfill these needs? I think it's the NBFCs who have built up a last mile distribution and who can then enter into a partnership arrangement, which is win-win from both sides. Having said which, I think this is a need, as I think Mr. Nath also said, that from NBFC standpoint, there is obviously the primary source of our borrowing is really the banks. So a co-lending strategy allows us to get a turn or two of additional leverage, which is off balance sheet from our standpoint. So it becomes sort of a great strategy and becomes a win-win in sort of principle, and it's kind of playing out in real life in small way. It's come a long way since the first circular came in 2017 and the second one and so forth. So I think we are at a cusp of the co-lending strategy taking off, and there are many challenges, but it looks like a very promising road, which will open up and become very broad as we go ahead. So that would be my sort of initial sort of comments on where this is headed.
Sure, I think quite a meaningful one. Mehernosh?
Yeah, I would just say that from the time it started, 2017-18, the first circular really talked about co-origination. And co-origination came along with a lot of operational complexities. So as Mr. Nath rightly explained, the genesis was to see how we can really build priority sector loans for banks, largely, I would say, public sector banks. And the NBFCs had the muscle in terms of origination, underwriting, and finally the collection. I think if you have these three pillars broadly in place, then you're in play for having the co-lending or co-origination going. A lot of representation was made post the first circular, and I'm happy to share that actually the regulator was very progressive, and they very quickly turned around a co-lending circular sometime in November 2020, which sort of really took care of a lot of challenges that the co-origination circular presented. Therefore, to that extent, they came up with a model 2 where the NBFC, against a harmonized credit program, could go ahead, originate, underwrite, and disburse. And subsequent to that, the partner bank would look to DA that transaction. Now, this really gave, I would say, some scalability to the erstwhile co-origination model. This actually helped start the co-lending journey in true spirit, if I would say so. And I agree, I think we're just at the start. I think it's like a baby. As we go along, there'll be learnings. What is important is that today the NBFCs can be a lot more capital efficient by working on this particular model, and therefore reinvest the money at the end of the day to reach out to more micro and small enterprises. So the last mile connectivity, which is the USP of NBFCs, is, I would say, the strength in which we are able to look at co-lending along with partner banks.
See, there is also a very close linkage between the prospects of our MSME sector and our dream to become the third largest economy, right, by 2027 or whatever. So if we really have to get to those levels of 5 trillion, 10 trillion, etc., which is being talked about, you can't do that unless and until the MSME industry itself grows multiple times of our GDP growth. Okay, because that is going to be the real backbone which will really propel the economy forward. So anything and everything that you do to further that particular cause is most welcome. So I think the entire history of the past 60 odd years of priority sector lending has proven that the banks are excellent when it comes to taking deposits, but not so excellent when it comes down to giving loans, right? That's how the DNA of a bank really works. So therefore, wherever there is a deficiency in the bank and there is somebody else who is far more efficient, naturally there is a handshake which becomes very relevant, right? And so that is exactly one of the reasons why co-lending itself becomes a very potent model. Clearly, there are, as you implement something which is as fundamental as this, there are so many factors that we need to keep in mind. And definitely this will go through its own ripples before it kind of settles down and becomes a really vibrant and efficient engine. So we look forward to that time.
For sure, I think not only the speakers come from different backgrounds and heading different companies, but I think the perspective is also very diverse. While Shachindra and Nath gave a perspective in 50,000 crore is the co-lending bracket that they are looking at, is a good observation. I think interesting points came up in the opening remarks. So, and when you specifically say, Srinivasan, that, banks are excellent at taking deposits, and maybe if somebody goes to the branch for a borrowing, they will ask, it's a lunch break, maybe come after some time, right? So maybe they're not very good at, processing the documents for the credit. And that's where NBFCs and fintechs can take part into it. So let me be very specific, and Vikrant, let me shoot this question to you. When we talk about the benefits between the collaboration, specifically NBFCs and banks, whom is it more beneficial for, the co-lending model?
So, listen, any good marriage works if both partners contribute to their best capability. It doesn't happen in real life, but hopefully it will happen in the co-lending space. But if you look at it, unless it's a symbiotic relationship which benefits both parties meaningfully, this ain't going to work. But I do feel that fundamentals of this partnership are very strong. And the reason I say that, let's look at it from both perspectives. First, let's look at it from, say, an NBFC's perspective. See, NBFCs, typically, if you are in an MSME-led NBFCs, which is lending largely to this market, whether through a secured LAP product or through a business loan product, your liability franchise is kind of directed towards borrowing from the bank market. You could do some capital market fundraising from debt standpoint, but largely it's the banks who are the largest provider on a liability side for a NBFC. And typically, you would see that your leverage capacity on the balance sheet could be between 3 to 4 times. If you're a housing finance company, it probably push it another turn of leverage on your balance sheet. And then you need further capital before you can raise further leverage on your books. And if you now see that based on that 3 or 4 turns of debt to an equity ratio, if you put on your balance sheet, and it will result in a certain return on equity for you, which could be, say, within sort of early to mid-teens, somewhere there from an ROE standpoint. But if you have to make your business model more attractive, and if I have to go and raise next round of capital from my investors, I have to obviously maximize the ROEs which I'm able to generate, and obviously able to sweat the equity as much as I can to maximize my ROEs and ROAs. What co-lending model does is that it allows a ability to allow me to put another turn of leverage, maybe say another 1 to 2 turns of leverage on off-balance sheet basis, because you're generating assets which are obviously of a higher magnitude, and you are putting about 20 to 50% of those assets originated on my balance sheet and balances on the bank's balance sheet. And what it also does is that if you look at the maths, if you're, say, lending at, say, 12%, and if you are keeping between 20 to 50%, adjusted for, say, the rate at which banks are able to take up this loan, which could be, say, between 8 or 9%, somewhere in that zip code. So the return on equity or the return on that asset for me for that loan could be between 16, 17, 18%. So obviously it becomes an attractive proposition because I am amortizing a higher fees or a higher sort of return on a smaller portion of loan I'm booking on my own balance sheet. So it becomes sort of a very profitable proposition from NBFC standpoint. From bank standpoint, what NBFCs are also doing is that they are bringing customers on board, which typically a bank may not lend to. The customer may not have a great credit history. The customer maybe somebody where the bank does not have a DNA. Banks typically go for prime lending, a yield corridor of between 8-9%, 7-8% to 10-11-12%, depending upon the rate cycle and depending on who you are. But here you are potentially also able to bring in customers who typically banks won't target. But from their standpoint also, they also realize they give us a parameters from an underwriting standpoint as to what should be the typical assessment criteria for getting this customer, which they would be comfortable putting up a risk on, right? And at the same time, they also know that an NBFC will be keeping about 20 to 50% of that loan on their own balance sheet, which means we have a reasonable skin in the game. It is not like you just go and get any customer. It is, we are also putting up that risk. So our underwriting standards have to be as high. Otherwise, we also tend to lose capital on the same loan. So if you put these three things together, like NBFCs have great to get from this model. And from bank standpoint, it allows them to access an end of the market and don't create a distribution network, which we are creating, and still are able to originate loans at a pretty attractive rate for them on a risk managed basis because of the protection they get of not a very sort of underwriting, which can be very reckless. So if you put these two together, I think it makes a winning proposition from both sides. And this is, and I can go into more detail, but this would be the large kind of thesis as I think about it.
Absolutely. I think you give a detailed version, but no direct answer. So no headline for me, whether it's beneficial for just banks or just beneficial for NBFCs. Yeah. Sachidanand, you want to add something?
No, I wanted to give you a headline.
Sure.
So I think so. It is like, if you go to West, so West, if you go to United States of America, specialty finance companies are there, or a lot of fintechs are there. I think so. So in all mature market, you have hedge funds who have capacity to give you money on warehousing basis. So multiple platforms which are highly valued, Funding Circle in UK, Cabbage and On Deck, which in COVID got sold, Biz2 Credit. Their job is to originate, underwrite, hold on balance sheet and sell to hedge funds, right? So that is why lending is always considered as a balance sheet activity, but it will converge to lending as a service activity. So all of the fintechs, all of the NBFCs, which were otherwise a balance sheet activity, will convert to a service organization, wherein we are basically a service provider to the bank and no longer just a leverage activity.
Leverage activity and converge to service organization. Converge is what the title of our event is. Sure, you partly give me a headline. We'll add some more spice to it and write about it. Sure. So, Mehernosh, let me come to you and try to understand in terms of how this model is shaping up. So the guidelines came in 2017. Before that also there was kind of a collaboration, but after 2017, it became quite aggressive. 19. So given the existence of co-lending, what kinds of difference the whole model has created in the system? Are we lending more to SMEs now? Are we reaching out to more retail investors? Are we catering to the unorganized sector, which perhaps we did not touch earlier because of the challenges which the banks face or something like that?
So I think I would say firstly, it's a win-win-win, okay, for the customer, which is the MSME, the bank and the NBFC. Okay. It is a model today that all three constituents benefit from. Now, how does that happen? NBFCs, when they lend on their own balance sheet, the cost of fund is always going to be higher because, you're not, typically most of the NBFCs are not originating CASA. And therefore, your cost of debt, whether it is through banks or for that matter through the debt market, is always going to be higher than pure play banks. With this arrangement, what you're effectively able to do is to bring down that cost to the end customer, because you have on one hand liability providers like banks. And we all know that while they are very large from a liability provider point of view, access to do loans to MSMEs is a challenge. Therefore, we come in and fill that gap as NBFCs, as last mile connectors, and have the ability to have customized solutions. So I think 2-3 things which we bring on the table for the partner banks clearly is the ability to customize, the ability to have data and analytics being worked together so that you get the right cohort of customers coming in. Third, it's a win-win even for the partner bank because you're originating high quality priority sector loans. These are all priority sector loans under the umbrella of the co-lending circular. Having said that, there are banks which have also who also have the dispensation to do, I would say, non-priority as well. But I think the focus of this is largely to go and lend to those micro and small enterprises which otherwise find it difficult to raise money. You see, 96% of MSMEs are micro. And we have to solve for that to ensure that the credit to be given to these folks is done well. And I think one classic example is the CGLS scheme, which the government of India introduced during the time of COVID. Over 11 million MSMEs got the CGLS scheme. And most of them, I would say, from what we hear in the research reports, over 85% of these have been able to carry on their business and are current in their loans. Okay, which effectively shows that despite telling them shut your business for 3 to 6 months, I mean, just imagine as a salaried guy, you don't get money for 6 months, right? This is exactly what happened to our MSMEs, where other than essential services and goods, they were all asked to shut shop. But despite that, I think a large part have been able to revive and do well. So I think if we give capital to these micro enterprises, they've shown us that, they are responsible. And I believe the co-lending way is a good way to look at synergies of banks and of NBFCs, which is to originate, underwrite, collect. If these two synergies do well, the answer is yes. I think, we are going to see a much better reach to MSMEs and also products and innovations which banks, after some period of time, will be agreeable. So today they are actually testing and seeing how it is going. But if the portfolio performs well, whether it is new to credit, whether it is completely, and by the way, the circular says, it's for the underserved and unserved. Right. The circular actually says that. Yes. So therefore, they're actually encouraging us to go and lend to completely unserved, which is new to credit customers. So therefore, I think the banks are pretty open. We've got to ensure that the portfolio quality stays sanguine. And if that happens, we will continue to see the momentum on this.
Sure, absolutely. And in fact, there is one argument that what if the bad loans, what if the loans given to ECL, under ECLJ schemes to MSMEs turn bad? But on the other side, if we would not have given these loans to 11 million, MSMEs, situation of the economy would have been completely different, right? Perhaps we would not have spoken about the growth that we are talking about today, which happened only because of the money that lent, and that would not have been possible only either for NBFCs or for banks. So I think the synergy point that you raised is really valid. So my next question is about the challenges, but the challenges in two parts. One is the underwriting risks, and second is the integration of the IT. So I will shift this question between two, Srinivasan and Shachindra Nath. So Srinivasan, I will first ask you in terms of, tell us, what are the challenges do you see specifically in IT integration? Because ultimately, when you want to go through a synergization model, it's not going to be easy, right? So what are the challenges that you see between banks and NBFCs?
See, I look at it in a larger context than just purely IT, because IT ultimately is a implementer of various other things, right? So what are the general challenges that can come across in the effective and smooth implementation of co-lending? Now, most important factor is that there must be a wavelength matching between the bank and the NBFC in terms of lending culture. Okay, I think that's the most fundamental thing. That means the bank has to trust the processes and the systems and the lending philosophy of the NBFC in order to lessen the pain to the customer, right? Because otherwise, if both the parties want to do their own formulas on the customer ends up getting the same amount of money but double underwriting, right? That is something which is very, very fundamental. So therefore, there has to be a lot of trust between the bank and the NBFC which needs to be there. That means the processes that they follow, the systems that they follow, the documentation that they follow needs to be harmonized, right? So one can't be paper-based, the other one can't be electronic-based. For instance, even these fundamental things need to be sorted out in a true sense. That's one. The second factor is, and which is something which hasn't been properly addressed in a true sense, is that most of the NBFCs, ones which have 500 crores and above, are called systemically important NBFCs. These systemically important NBFCs follow the new Indian accounting standards. Okay, whereas the banks are still in the old accounting standard, which is called the IRAC norms, right? Now, NPA recognition, income recognition, amortization of fees, these are things which are completely differently dealt under the Indian accounting standards versus the IRAC norms, okay? So, a definition of an NPA account under IRAC could be radically different than that of INDAS. The amount that you need to make a provision for needs to be radically different. So if the same customer gets viewed in two different ways by a bank and the NBFC, what are we really going to do? Okay, whose viewpoint will supersede the other? This is one very fundamental question that needs to be answered. Because what you implement on your accounting system or the IT system emerges fundamentally from this, right? So that is still not been fully answered to the best of my knowledge. So I think this is something that we need to further sharpen as we go along. The third factor is, in terms of, suppose, let's say it's become a bad asset and all of that. Now you need to use this wonderful act called SARFAESI Act, Securitization and Enforcement of Security Act. And you need to, let's say, repossess the asset of the customer or get into some kind of a forcible action to recover the money. Now, let's say a 5 lakh rupee loan, okay, or a 10 lakh rupee loan, the bank can take SARFAESI action, NBFCs can't. Because below 20 lakhs, SARFAESI is not available to NBFCs, but it is available to the banks. Now, who's going to take the first call? Now, if the NBFC is the front end and the bank stays at the back end, can the NBFC enforce under SARFAESI for a 5 lakh rupee loan? Or do they have to put necessarily the bank as the front end partner as far as collection is concerned? Again, you are having a switch between who's going to be the front end. This is a very fundamental question that needs to be answered. Otherwise, there will be disharmony in the way an NBFC will approach it and the way a bank would like to approach it, right? So, some of these fundamental questions need to be answered, and then we get to a solution where, okay, the processes, etc., are harmonized across banks and NBFCs. Now comes the question of system integration and IT development, right? So IT comes right at the end, which I think fundamentally, compared to the other problems which I mentioned, is a relatively easier thing, right? Obviously, the two systems will be different and you need a middleware to ensure that there is no fundamental difference between the way the two entities account for it. But good thing is that a lot of the IT developers are actually working on middleware. I believe I met somebody who's created a kind of a pipe between a NBFC accounting system and the bank accounting system. But such things will emerge over a period of time. Yes, the final word has not been said, but at least people are thinking in the right direction. I think over a period of time, these things will definitely settle down. But the fundamental thing is those initial three things that I mentioned in terms of income recognition and the NPA recognition, SARFAESI, and the overall philosophy. Those needs to be answered very clearly before we come to the IT systems.
Yes, Shachindra, on the underwriting risks, disbursal, what are the challenges on that front as you saw, Srinivasan spoke about the IT side of challenges.
So देखिए शाम हो गई अभी आपके वो जोरदार आवाज वाले MC आएंगे and then he will say, what kind of panel is this which is boring people and we have to hit the bar. So I'll describe this. So I'll give you a small story. So one of the largest bank, I won't name, signed up co-lending arrangement with us. The chairman of the bank actually signed the agreement, and at the time of signing, he asked me, "आप Mr. Nath 6 महीने में कितना business करेंगे?" Obviously, sitting in front of him, I also said, "Sir, 500 crore तो कर ही देंगे." Then obviously he must have noted it down. 6 months passed, and one day I received a call from his office saying, "Please show up your face in front of him again. You have a 15-minute time. And objective is to come and explain that why you have done only 21 crore of the committed 500 crore." So मैं पहुंच गया उनके पास और उन्होंने बिल्कुल पूछा, "I think that we should terminate our agreement because you are highly unsuccessful and you committed 500 crore, you have done 21 crore in 6 months time. So give me reason." And time was 15 minutes. I didn't know how to answer that question. So I said, "Sir, आपने ये movie 2 States देखी है?" He said, "What does that mean?" I said, "No, sir, this is a simple question. Have you watched this movie called 2 States?" He said, "Yes." So I said, "Sir, वही वाला problem है. Think of a South Indian Chettiar girl getting married to a Punjabi boy. Now this is the current world. Both of them have lived together in an IT or in an IM, and they want to get married. So Mia Bibi Raji. Now it is about the family, because marriages in India is not about these two individuals coming together. It's the family has to come together. Now the girl's father is saying the marriage would happen in a temple, in a peaceful, calm environment, under the auspices of God. And obviously Punjabi boy's father said, "भाई हम तो रम और विस्की की बॉटल खोलेंगे, शादी कर रहे हैं, कोई मजाक थोड़ी हो रहा है यहाँ पे." तो यही हो रहा है प्रॉब्लम सर. ये मियाँ आप राजी हैं, हम राजी हैं. अब ये साउथ इंडियन और नॉर्थ इंडियन फैमिलीज हैव टू कम टुगेदर. And that always take time because हमारे यहाँ होता है अब current generation में जब लड़का लड़की तय कर लेते हैं कि उनको शादी करना है तो family finally come around. It just takes little bit of time. So just give that time. तो he said understood, but खाली ये बता के जाइए who is bride, who is groom. मैंने कहा सर आप bride, आप बैंक हैं, आप ही groom हैं, हम तो bride ही हैं. So that's the challenge. Is the challenge of a culture of two very different systems.
Absolutely.
Wherein you have to align the whole system. So what KV talked about, technology, process, regulation, all of that, it is just taking sheer amount of time. But the commercial and the industrial logic of this and the regulatory force and the policy push would make it work.
Yeah, sure. So apart from the marriage, the anecdotes for all of us is the Yugoro Capital still has more than 500 crore of balance sheet, and which is the ready to हो जाएगी.
शादी तो हो ही जाती है सर, शादी तो.
I think I'll just take that analogy forward. And there is also, maybe once the marriage goes, there is also a kid, right, who's the borrower. So unfortunately, now there are two lenders and you have to now generate 3 records. One for the borrower who has 100 rupees loan, which is now gets split with the groom who has 80 rupees and the bride probably has 20 rupees, and all 3 accounts have to manage. So nobody knows how much is owed to whom. So I think that's another big accounting challenge, because the systems have to talk to each other. You have to generate a statement of account. You have to say, मेरे system में 80% आएगा, मेरे system में 20% आएगा, और borrower के पास 100% जाएगा. So it becomes, really on ground, it's a real challenge in terms of just executing some of these nuances, which may sound very boring, but when you come to real ground, it's a real sort of a mess.
Sure. So I have 2 important questions for the speakers here, but before that, if anybody has any specific questions, I can make the floor open. Any specific question to any speaker here? Okay, cool. I think you can think over it. I will come back to you again. But let me come back and ask these 2 important questions. The first one is specifically, and this is a common question to all. So when we speak specifically about the 20% and the 80%, model, is the 20% share of individual loans on book by NBFCs and 80% by banks, तो इसमें अगर default हो गया, तो whose responsibility it is? We partly discussed that, but let's be very specific to it. कि because we are discussing electrifying co-lending, तो इसमें shock किसको ज़्यादा लगेगा? Srinivasan, I will start with you.
नहीं, shock तो दोनों को लगेगा. The question is that who's going to be blamed for the poor wire connection, right? So that is the fundamental part. Obviously, from the perspective of the bank, since the front ending and the underwriting is essentially done by the NBFC at the first port, naturally the risk carried by the NBFC will have to be disproportionate. From a reputational perspective, financial risk is equal. There's no problem there, right? So therefore, and let us be also fair, that from a collection perspective, the alacrity which can be shown by an NBFC will always be better or higher than that being shown by a bank. So therefore, it is also commercially viable for the NBFC to take the first step and do the forcible collection or otherwise any other legal action, etc. Because they tend to be far more flexible. They tend to be more connected with the customer because they are the ones who first interacted with the customer, right? So the ability to get out of a sticky situation is fundamentally more with the NBFC than with the bank. So clearly, a disproportionate share of the responsibility for collection will be taken by the NBFC. Otherwise, this model will not work. So the 80-20 only stops at the financial liability, but the operational liability or operational work which is being done will be definitely far more significant for the NBFC than to the bank.
I think just to take the analogy of the marriage forward, since it's now 2 states, right? We are all in a honeymoon period right now because we've just started co-lending seriously in November 2020. It's just been a year, a little bit over a year. And obviously, if you underwrite with some due diligence, you're not expected to have delinquency so soon. So clearly right now we are in the period where everybody is enjoying. We've really not seen any of the child coming and saying, I'm not able to pay. And that's a good sign because I think we've started strong and we should ensure that the portfolio stays good. But as we go along, I think one is very clear. It's a true sale, and therefore 80% loss will be taken by the partner bank, 20% will be taken by the NBFC. But there are many aspects to it that one needs to be clear about. Most of the banks that you deal with are also your liability providers, right? So therefore, strategically, what you want to ensure is that you don't end up having a very large loss rate, because when you sign up with a partner, there is also an agreed credit cost. I mean, if you're in the lending business, there is going to be some credit cost, and therefore I think bankers understand that well. As long as you play within the agreed credit cost, I don't think that's a challenge, right? Because especially with public sector banks, we all know that the GNPAs and NNPAs that they've had are far higher than what we are talking when we sign up these agreements. So I think to that extent, if we are within the agreed credit parameters, the risk-adjusted yield that the partner bank is getting is good. I don't see that to be a challenge. We have to ensure that the focus is on the credit, and like Mr. Srinivasan also mentioned, the NBFC carries the end-to-end responsibility. The entire customer life cycle in co-lending is front-ended by the NBFC. And therefore, whether it is a customer service request, tomorrow a collection pickup, or for that matter, any other requirement of the client, the NBFC is the first port of call for the co-lending customer. And the bank at the end of the day is just there. I mean, it supports and ensures that, the reconciliation, etc. takes place. So to that extent, we have to be very clear that when you sign up, you are front-ending the whole thing and responsible. There is an 80-20 match-off, but like I said, it's there on paper, but what is more important is the larger relationship with the partner bank. And if you do well in that portfolio, I think the opportunity for the NBFC to scale up with other banks, get more lines from the partner bank is much, much higher.
I think that's a very, very valid point which she has made. When you approach the banks, and these days the conversations are, ki, acha, bataiye, term loan mein how much money will you give? They carve out a certain, a revolver or a working capital line, and then they give you an allocation from a co-lending standpoint. And 500 crore, 21 crore, I think if you don't fulfill some of those requirements, these tend to kind of come back, because they are also looking for an asset creation and a volume. As I said, if a true relationship has to work, they also want to see a size and a scale which comes out of this relationship. If you are delivering 5-10 crores on a monthly basis, I mean, for these large banks, the relationship will willy-nilly kind of die off in natural death. So I think it's a responsibility from our approach is that we are, creating this partnership with a select few. But then in terms of delivery of saying that, if we commit a certain amount of volume, say 25-50 crores on a monthly basis, then we are able to deliver that, because, that at least starts and ensures that there's a relationship which is of meaning and of value to these banks. If they don't see that, then, it will fall off. And secondly, I mean, during this flirtatious honeymoon phase, it's great. But as the portfolio season, especially in a lab business, you start to see the true color of the book, say, call it 24 months down the line, or 28 months down the line, where the true delinquencies start to come up. And if they are exceeding, say, the risk which the bank is willing to take, obviously the relationship is going to turn sour, and it will affect you then on multiple grounds, whether it is on balance sheet exposure they are willing to take, or on the co-lending bucket. So for it to work, it has to be a journey of growth, but which has to be profitable on both sides. So that's where I feel that sometimes banks have a thought process which still comes from lending to prime customers, where they budget in a very small credit cost. And here you are going to maybe potentially a customer pool which is new to credit, which has not taken credit. So potentially the delinquencies which we have seen in our portfolio could be a little higher. And that's where the readjustment will happen, whether in terms of pricing, where, for example, if they're doing and saying that, hey, listen, we are happy to take a 8.5% pricing on the loan and you take the balance. Now that may move to 9% or 9.25%, because maybe the losses have come up to be more as they look back on the portfolio which got created. So I think it's going to evolve over a period of time, as we see this.
Yeah, so as far as regulation goes, co-lending regulation are very clear that this 80-20 sharing is at a pari passu level. So risk and reward has to be shared in that proportion. So that's the point one. But obviously, as KV said, that there is a more operational cost which NBFC is bearing. So to that extent, NBFC is taking more cost. Third, what is now, and banks are also maturing, banks are now started looking and pricing the risk upfront. So we have, nine co-lending signed up, very active. 30% of our book is in co-lending. And banks are now saying that, okay, and we are also proposing that if you are signing up a unsecured product and expected loss ratio is say 3%, then you please, price it upfront. So don't give me a co-lending rate of 9%, give it 12%. And please document that the additional 9 to 12% we are giving you the margin, so that the losses you should, sign or set off from there. So tomorrow don't blame us for that, right? So that is the way it is happening. Or also, few banks actually, and even public sector banks are now doing cohort-based pricing, what they call risk-based pricing. First 100 crore आपने लोन किया, उसका अगर portfolio loss 2% से ऊपर चला गया, तो next cohort की price बढ़ा देंगे वो. So that is the way also they are doing it. But having said that, I think so, and we have pitched this to regulator, some of industry bodies also doing. At this point of time, there is little bit of, disconnect. So there are multiple forms you can work with the bank. You can go and sell your portfolio in form of a securitized instrument, which is called PTC. And I, as an NBFC, can give it up to 20% credit enhancement, which means on that sale of portfolio, first 20% loss is borne by us. Now I sell the same portfolio through a direct assignment route. I can't give any kind of credit enhancement. I do the same thing in co-lending. I can't give a credit enhancement. The role of the NBFC across these is the same. We are the servicer. We earn a margin, and for earning a margin, there is a service element and there should be a credit enhancement element. And also now there is a new complication which has been brought in. There is a digital lending guideline. Now it's odd, which means that a fintech, a regulated fintech, or a NBFC to NBFC, you can do a co-lending or origination partnership, and actually originator can give up to 20% of credit enhancement. So if I, as a UGRO, do co-lending with another NBFC, actually I am now officially allowed to give up to 20% of first loss cover. While I do the same job with a bank, I can't do that. So eventually all of this need to be harmonized. I am of the opinion that banks, for providing you that margin beside the services element, should be officially allowed to take some kind of first loss cover, because when a bank lends to the balance sheet of an NBFC, it is relying the margin regulatory capital. So regulator says 15% ki capital minimum chahiye, which means our equity base protects the first 15% of loss, right? So that should be provided when it is being done, or some portion of that it need to be done, but it would also evolve.
Quite meaningful thoughts for sure, and I think this is a very thoughtful model. I think this should actually work in a what I can say, to cater to the large audience of the country. So let me come to my last question, again common for all of you, and let me put it in this way. So we discussed marriage, honeymoon, and everything. तो अब एक घर बनाना है, हैप्पी फैमिली बनानी है, all the rules and regulations are already there, but दोनों को साथ में रह के सब कुछ करना है. So what are the things that you think are required to build a happy family? Which simply means that what do you think will work to electrify co-lending going ahead? Because we are still in early stage and maybe we'll take some time to mature. But what will actually work to make this relation really strong going ahead, so that we can cater to a large number of people in the country and actually fulfill that agenda or accomplish the goal of serving or underserve the category which is still under the priority sector lending norms. I will start with you, Srinivasan.
If I have to pick out one item, and I'll say only one item, which is the fundamental thing which I said on day one, on the beginning, if you need to have a happy family, the husband and wife should trust each other. I think that is the most fundamental thing that will build the home and make it happy.
I think aligning interests, and the way I look at it is, think of it like a joint venture. When you think of it like a joint venture, both parties want to, do well, right? And therefore, I think aligning of interests and thinking of it as a model where both succeed will ensure that, this is a successful model.
I think at least my parents told me if you go through your first year of marriage well, I think then it should get better. I think after the honeymoon is over, portfolio seasons, some trust builds up. One realizes that there is a symbiotic relationship. Both sides like each other. Both sides can work with each other, and the kind of the husband also takes care of cooking sometimes. The accounting is taken care of, and so on and so forth. I think those challenges over a period of time, my senses will get cleaned up. So the friction which is today in terms of these many nuances, as they get cleared up, as the portfolio season, as there is settling in terms of a portfolio originated through the co-lending route, generates A return and B loss rate that gets adjusted and factored in, I think then it takes off to generate more volumes. Because what will also happen is that as NBFCs, I'm talking from our standpoint, we see this as a profitable model. We are going to put and invest more resources and consume more OPEX behind it, right? We are going to build a more larger origination machinery at our end, hire say 500 more sales originators through a physical infrastructure or originating through a digital infrastructure. So we're going to make even greater investments. So once kind of this period goes up, then I think all these things will kind of play out over a period of time.
So one of the things which you were asking, that these giant banks and small NBFC, what is the correlation? I never wanted this to become a marriage counseling session, but since it has become, I would give one more analogy which my father used to give me कि जब भी हम शादी करते हैं तो लड़की अपने से छोटे घर से लाते हैं, right? And तभी वो marriage successful होती है. और आपको मैंने बोला, बैंक को मैंने बताया था, we are bride, banks are grooms. So हमेशा successful marriages happen historically. Obviously, this generation won't agree. When the girl is coming to a more affluent family and is willing to adjust. So our ability and nimbleness to adjust to the bank, because they are much larger, is what would make work.
I think very interesting thoughts, and I got good headline for sure. So quite meaningful thoughts, quite realistic thoughts, and let's hope this model will work. Let's hope मतलब सुखी खानदान परिवार बनेगा. By the time we come with Converge next year, maybe हो सकता है तब तक family mature हो चुकी होगी. As Vikrant said, एक साल शायद हो चुका होगा from this panel. But I think really meaningful thoughts, great learning for me, and I'm sure all of you also got a different perspective from the panelists here. So thank you so much for sharing remarkable insights and your experiences and maybe your daily, things that you go through. I think really remarkable thoughts here. And thank you, ladies and gentlemen, for listening to us very patiently and, being a great audience. Thank you so much.